recently we've heard much talk about that 7.5% inflation print. It's been all over the news and it's been memed out on Instagram, on Twitter, endlessly about Team Transitory and, you know, all that jazz. So, being an experienced inflationary period survivor myself from a different country that experienced hyperinflation, I'm partial to those thoughts. I'm very much afraid of inflation, more so than the average American. So I decided to be objective about the entire situation and go back in history a little bit, and I found actually a great article that puts things into perspective. Now, although I still do think that inflation is a very much long-term trend, I don't think that it will be an ever escalating, accelerating trend from now on. I think that it will return to kind of a normal rate of currency units depreciation in the future. So this article here, let me pull it up. It's from the White House. Historical parallels to today's inflationary episode. Now, although this information may be partial, I did find some interesting data points here. One of them is this graph, which puts things into perspective as to how long the inflationary spikes actually last. So I started this kind of research because I heard on a financial podcast that the chances of inflation being under 5% is in the single digits next year, this year, and probably next year. Because historically, when inflation has risen past a certain percentage worldwide, globally, it has sustained that through at least one more year. In fact, it normally accelerates. However, this isn't just any country. This is the United States of America. And no, it's not different this time, but it is the reserve currency, so actually it is a little bit different. So if we look at this graph, I know that the CPI is measured wrong, and I know it's biased, and I know the inflation is actually higher than measured here, but there is still some data compiled here that can be referenced, and what we're going to be looking at is just these spikes and see how long they last. They tend to very much turn around quickly, just like commodities do in commodity cycles. Commodities tend to spike, overall the trend is down, but they do tend to hit a peak, which then causes them to sharply reverse in price whenever the issues are cleared. So what are some of these issues, by the way, that cause inflationary pressures? Well, you could have inflation be caused because of demand, right? You could have demand pull, meaning like there's a lot of currency circulation in the economy, and therefore it's bidding up all of the goods and in an uneven manner, and as a result, the supply is short because there's too much demand. Or you could have a supply shock. So if everything is normal and growing at a steady pace or declining at a steady pace, you could have an episode of time where supply is interfered with somehow. For example, through our most recent episode in March 2020, and goods are unable to be produced and shipped to the appropriate places. And so that causes a lack of supply, and therefore prices rise as currency units are chasing for fewer and fewer goods. As the supply shortages get cleared, because the prices of the goods are so high that it motivates businessmen and producers to fill in those gaps. As the prices and their supply shortages work themselves out, the prices tend to go back to normalcy. And however, the demand side doesn't necessarily always resolve itself. So with the printing of more and more currency units, the cycle may never stop, and in fact, it may accelerate. Those those are the kind of circumstances that lead to hyperinflationary scenarios. and I know because I've lived through one, and so it's motivated me to study a lot about it. Now, back to the article here. For the third time, I'm pointing out that these peaks, they tend to resolve themselves very quickly in the States. Now, I'm not saying that this is in other countries. The situation right now actually could be argued that it's a little bit different because the interest rates are very damaging for markets and the economy. They're very tied together right now as opposed to back in history. Um, However, I think what's happened is because the units are so numerous nowadays, even the slightest percentage change just magnifies the effect that it would otherwise have. So I would guess that even just 1% or 1.5% rate hikes from here will definitely help to stave off some of the inflationary pressures. But actually, I don't even think that that's the biggest or even a big factor that plays into this inflationary episode. I think it's the two things that I described earlier. Number one is the supply shock, and the supply shock is resolving itself. I know that big producers around the world, like China, for example, has had to lock down their workforce yet again, in some cities especially. And I know that that's dragging on the ability for the world economy as a whole to produce anything. Many of the goods that are produced worldwide go through China. So that is adding to the inflationary pressures. And the other pressure is the biggest consumer in the world, which is the United States, has had a monetary boost, right? Printing of a bunch of currencies for either unemployment or business loans. I know that, for example, many businesses were able to get $500,000 or more worth of basically free money, and many workers who are employed for no fault of their own were able to receive benefits with bonuses to be able to sustain their living conditions. And I'm not making a judgment, by the way, whether it's wrong or right. I'm just saying that those are the facts, that's what happened, and those are the actions that led to the current inflationary periods that we're experiencing right now. And so, what I'm thinking from here is the following. One is the supply chain issues that are getting resolved. However, we're still struggling a little bit because labor force is a bit inconsistent, and so but inflation pressures from supply side should ease. And two, I think that the unemployment benefits are basically over. There are very few businesses that are getting free loans right now from government help and directly printed from the Federal Reserve, right? And so I think from the monetary standpoint, the pressures are decreasing there as well. And so I think with the productivity increase that we're experiencing, the inflation will subside. So here's the graph. So this is real gross domestic product. So this is taking out inflation. And yes, I know that inflation is not measured properly, so maybe we can take this with a grain of salt. However, it seems like on the top right corner you can notice that since March 2020, productivity has been accelerating pretty fast, trying to meet its previous trend line. And so once that previous trend line is met, which is basically soon, then I think that we'll see things normalize. And perhaps if this moment comes about too quickly, we could experience a short-term economic crash, or markets, because those things pretty much never happen in an even manner. It's usually some kind of a shock. So we could have a sharp correction. But look, some argue that we've already had this correction, especially in the tech sector. Many of the stocks that benefited from the influx of cash and low rates have now come back down to earth. Just ask anybody holding PayPal or Peloton or Facebook or ARK investment ETF or innovation ETF, or basically any of these growth stocks that just been getting killed recently. Pinterest, just anything. Just take your pick. Any of these high flyers, Shopify and Etsy's of the world, etc. Some would argue that they're actually fairly valued nowadays, and perhaps maybe even more to go, but it seems like they could be finding a bottom in the next 6 months, perhaps another 5, 10, 15% correction. That may or may not drag the rest of the market behind, because from the current episodes, some other companies are benefiting to kind of offset those losses, and it doesn't seem like the monetary side is subsiding that fast. So most of the money are actually going into stocks and other assets. I think part of the reason for that is because the amount of free cash that regular people had flowing through in 2020 nurtured a little bit of a culture of investing, surrounding Robinhood and YouTube, TikTok, and all that. And so a lot of the Gen Zers and young millennials got an exposure to an alternative method of making money. Unfortunately, or fortunately, I don't know, it depends on your viewpoint, a lot of that money went into crypto assets instead of productive ones. But, some could argue it's a super long-term investment, and I'm not an expert in that, so I won't comment. But I think that culture that's been nurtured is being expressed now, and I think that the share of the market being owned by American citizens is actually going to increase in the future. We're going to become, will continue to become kind of the investment capital of the world, even if our economy shrinks in size relative to some other more populous nations, namely China, India, perhaps Indonesia in the very far future. I still think that the U.S. will be kind of like the Singapore of the world, or something like that. Okay, so those are my views on inflation. I just wanted to make a little quick video here on Sunday, just because I'm not doing much right now, so I figure I should maximize my time and provide some videos on YouTube. Congratulations to the Los Angeles Rams, by the way, for winning the Super Bowl. It was a tough game for the Cincinnati Bengals. I feel you. I understand your frustration, especially in the last few plays of the game there. So with that said, hopefully you guys are having a great weekend, and I'm super excited to see what happens in the week ahead. It should be a red one, considering some geopolitical pressures coming in from the east, especially from the Russian front. Speaking of the Russian front, you may want to consider next week once it crashes. If it crashes, consider buying up the RSX or some other Russian equities, because of the kind of the buy, what's it called? Two-sided trade, right? Like flipping a coin type of trade, where someone put it really nicely the other day, where I was listening to a different podcast, and someone said that it's kind of like, well, you either buy, if things get resolved and you own the Russian market and it's going to rebound from there, or things don't get resolved and the money in your portfolio is the least thing that you got to worry about, right? You have basically a world war on your hands. So you might want to consider that. By the way, nothing I said is, of course, financial advice. This is just my opinion, and for any type of equity that you purchase, I would suggest you do your own due diligence. And if you're not sure what to do with your wealth, please consult a professional investment advisor so they can help you out on your journey. All right. I think that's it for now. Peace out.